Hello everyone and welcome to Jim Dalton's presentation, How to Use a Market Profile to Size Up Our Competition. It is December 11th, 2014, currently 12 p.m. Eastern. We'll go for about an hour. And this recording will be posted at our site in about an hour after the presentation. We'll have it up for you. Okay, so everyone, great to see you all. We have a full house here, so thank you to everyone from Jim and I for coming out and making this a part of your day. We appreciate you taking time out. And really neat to see you all. I see some names I haven't seen in a while, so welcome. And with that, let me please introduce Mr. Jim Dalton.
Hey, good morning. At least good morning out here. I'm on Mountain Time. It's 10 o'clock out there. East Coast is noon. We're doing a series of these. Some of them we do about the time they close in Europe, make it a little bit more convenient for part of our substantial overseas client base and other base that we keep in contact with. One of the things that we talk about consistently in our educational programs is understanding the market in terms of the behavior of the people that you are constantly competing against. And that is really it's complex but understandable. But let me start off with a very concrete example. Okay, we are currently, we have two programs going currently. One, we're advertising for an intensive that we begin, I believe it's the 20th of January, someplace around there. But leading up to that, we have what we call a continuation program, which takes people from the last intensive through the intensive that starts in January. The idea being that through a chat, I do a one-way chat comment almost every hour that the market is open, unless I have a doctor's appointment or something like that. And through that chat comment, we are trying to, something happened here. Through that chat comment, we are trying to be as hands-on and as close to mentoring one-on-one as we can possibly be. And we understand the markets are complex. The slide in front of you is from yesterday as of 1:54 p.m. Eastern Time yesterday. At that point in time, the point of control developing in the morning was right up here at the 20.45.25 level. The market, it opened, came on down, and kind of looked like the letter B. The letter B signifies to us that we are seeing liquidation. The difference is, when we're talking about the behavior of the people we're competing against, when we see liquidation or we see the non-elongation of this early profile, that is a sign of what we call old business. So it's people that are liquidating existing long positions. Now that is contrasted to a more elongated profile early on, which would have a more likely indication that we were seeing not only liquidation, but a combination of new money selling. We go through yesterday, and the market is one time frame down, A period, B, C, D, E, F, G. So 1, 2, 3, 4, 5, 6, 7. One time framing down for that entire period, followed by, in H period, the market looks above the G period high by 2 ticks. When there is no follow-through from that, that is normally a very weak sign on a day time frame basis. And this is important to distinguish between this early idea of what was going on before we see the completion of yesterday. If in fact we had really good, strong selling of new money in the morning, we wouldn't have seen this profile look like the letter B. We would have seen elongation. However, when the liquidation has been consistent all day long in here, other than this one period, you've got to say, wait a minute, there's some longs that are caught out here in the market. And then let's take a look now at the next chat comment. This is an intraday chat comment. This is part of what we call this continuation program. And Julie and I were on a call, and I chatted back. I got called away from for a phone call. The last period took out the prior period by 2 ticks with no upside follow-through. That's the high that I just showed you right here. The 2 periods were H ticked above the G period high. It is not unusual to see short-term selling come in at that point. The selling has been consistent all day. I continue to think that the selling will be short-lived or short-lived. Next comment a minute later. By that comment, I meant that I would not be surprised to see a rally later tomorrow or Friday. The tone continues heavy for today. That was a minute later at 1:55. That was to clarify the timing element of my comment. A lot of times what you'll see when the market gets a tone for the day, and yesterday's tone was clearly to the downside as one time framing, all but that one period. And for those that don't know, one time framing simply means that the second period did not take out the high of the first period. The third period did not take out the high of the second period. The fourth period did not take high of the third period. It has to be by 2 ticks. So, but it's also not uncommon to see one period that stops one time framing in a day like yesterday. And we saw that in the one period. So now when you look and you see the comments, by comment I meant that I would not be surprised to see a rally later tomorrow or Friday. The tone continues heavy for the day. That comment saying that once, and we find so often that once there is a tone for the day, it carries through for that entire day. You get this emotional level that takes place in traders, and they can't see anything else but selling. Then the next comment said 2131 level, the low from 3 weeks back, is the next lower reference, and that was made at 213. Now, the Essence pitch session, the low for the day was made down at the 23 level. So you see, once we broke out, it did continue down. So we, other than this one period in each period, we one time frame lower all day. One of the things that you don't do is you do not step in front of one time framing. A lot of people, I'm sure, lost a lot of money yesterday because they kept fading the market to the downside. If you do fade a market like yesterday, you have to be right very quickly. The pressure was to the downside. Okay, now take a look, and let's go to the next slide. The M period rally high. So we made a low in L period. We rallied all the way back to 2035.25. That's a huge rally on the way back. And at that point in time, that, again, remember early on, I made the comment, put it in writing, that I thought we would see yesterday's market retraced or recovered, or a rally late today, became early today, not late, or tomorrow. What I'm reading is that the selling that's going on in there is liquidation. It's not new money. It's not new money selling. Now, everybody gets excited when they see the market go down, straight down like this in this liquidation mode, they really immediately want to say, oh my golly, we've got longer term selling coming into the market. Remember, in the morning, we did not have elongation on the profile early in the morning. It was very squatty. It is very unlikely that you will see longer term money wait until late in the afternoon to sell. Usually, if they're going to be selling, they're going to be selling all day long. And you'll also see a great increase in volume as we track the volume on 30-minute periods. Juliet, can you bring up your screen and can you show people how we track the volume using the NYSE?
Yes.
If not, I'll keep talking.
I have it.
Okay.
I have it here. Well, you can get it at Yahoo Finance, and what we do is we track it at the training site for the intensive as well. So if you look at, we'll just so we can all look at the volume together. Okay, so can you see the volume on my screen?
And see, okay.
Everybody can. So basically we're looking every 30 minutes. No, Armand? Is there sound? No. Yes. Armand, just check it. Check your screen one more time, make sure it's active. So we're comparing, and one of our intensive traders did this for us, and basically we can track the volume through many days on the right, but basically we're looking at every 30-minute period. It's a visual. Yes, we download it to a spreadsheet, but basically if you'll notice 10 o'clock hour today, 466 versus yesterday's volume, and basically we track this throughout the day. So I will put that symbol into everyone where you can get it on Yahoo Finance. Nicey site used to have it, but they've bailed on it. I don't know what happened to the link. It's not working, but you can certainly get it at TD Ameritrade. And Todd, if you have that symbol for TD Ameritrade Thinkorswim people, could you type that in? I don't want to, Jim, you have the screen back. I don't want to type in the wrong one to everyone.
Okay. So now also, along with this, we have three principles. Price advertises opportunity. The biggest, and the sideline, the biggest mistake traders make is being price-based traders. Price advertises opportunity. Time regulates all opportunities. And volume measures the success or failure of the advertised opportunities. So as I was tracking yesterday, and I'm getting this break to the downside, until the final couple of periods, mostly came in on this rally, the volume on yesterday's break was mostly below the volume for the previous day. So this huge decline, and it's actually on decreasing volume until we got heavy volume in this last period, and I think a lot of that came in on the buy side in here. So before we move on to the final slide, remember we're talking about this idea of behavior, and we're talking about how do I use the market profile to track that behavior. I'm going to back up for a couple slides here. Okay, when you look back, this is what we call the point of control. Another word for point of control, and a better word, is the fairest price at which business is being conducted. When I see the fairest price at which business is being conducted up here, and then late in the day I see so much selling on the downside, the first question that comes to my mind, are traders getting short in the hole? Are traders getting short in the hole? Are they selling at prices below value? And remember, that's what I thought yesterday. And remember, at 154, 155, I said I expected to see a rally late today or tomorrow. And the reason was it looked to me like there was an emotional selling going on, and traders were just doing knee-jerk reaction, selling prices deep in the hole, or what we call selling below value. When you see those opportunities, and part of the thing that comes up in here is traders, one, they spend too much time in most cases focusing on price, and secondly, the expectation is that want things to happen their way and happen too quickly. And when a market gets a tone like yesterday, and we're looking at it organized under the market profile, and we're looking at the fairest price level, so well, guess what? For today, it's got to run its course. So if you're trading a day like yesterday, the market is one time framing lower, all but that one period that we showed. So there was nothing that said you wanted to fade that market. Did I want to fade it from time to time? Yes, I did, because I thought the market was getting too short. But at the other side, it didn't look to me like the liquidation was completed. And so what we're trying to say, what is the behavior of the people that we are competing against? So you see the market, they finally got that liquidation. The later it gets in the day, the less odds there are that there are going to be people there, to step in and buy. So the market traded off very, very substantially throughout the day. The other day, and let's go to the next slide. So we had a rally back up to the 2035.25 level. I said, wow, that's a pretty big rally. That's a huge rally. And quite honestly, it was what I expected. I put a chat out yesterday afternoon that said I just stepped aside yesterday simply from the fact that I really didn't trust the market on the downside. Yes, did I miss a lot on the downside? Yes, I did. But there is an awful lot to be said. If you don't understand the market, step aside. And I just elected to step aside from the market yesterday. First of all, we were on a phone call, so I didn't get this break. I was unable to catch this break as the market moved down. And I don't chase markets. And I also didn't chase this. I said, I'll wait until the morning. Well, now the next thing that happens, the market rallies all the way back up, and then late in the day, it rallied back up to 2035.25. Late in the day, it breaks all the way back down almost to the low for the day. At that break, again, now remember, we're out here talking about appreciating the behavior of the people that we compete against. This was the huge trap. You got some of the short inventory was relieved on this rally, but over anxious traders step in and just sold the daylights out of this thing late in the day, almost back down to the low. This is where the trap occurred. This was the final thing that set up the rally that you saw today. This emotional selling that, oh my God, this market's breaking. They get a rally and they just lean into it late in the day. The trap for what happened today was set. Okay, now this is what the day looked like. There was the prominent point of control. Here was yesterday's settle. Here was the final trap in the marketplace. Now let's escape from here for a second, and let's look at today's rally. Okay, let's go back to that 2035 2035.25 reference, which was right there, was the afternoon rally high. One more time, we use rally highs and pullback lows as important behavioral references to work with. So we say when the market rallied up here yesterday and then did the late break back down to the lows, okay, we've got ourselves a containment area from that rally high down to the lows and said, okay, there was an awful lot of volatility within that range. We have a pretty good idea if we start trading above the 20-35-25, all of those traders that shorted late in the day are caught short in the market. Now, we do a morning, along with this continuation program, which leads up to the intensive, we do an evening report and a morning report. Last night's, what we call it the recap and preparation report for trading today, started off with my saying I was suspect of yesterday's break. And what I really thought, I thought the market was very short in the whole, or short at very poor prices. Overnight, we did the morning report this morning. We did it prior to this FGH high. The market, at the time we did the report, the overnight high had been exactly at 2035.25. So at that point in time, we knew we got back up there overnight. We knew we had a good behavioral reference, and that behavioral reference was 2035.25. If we got above that reference, now remember, again, we're talking about understanding the behavior of those that we compete against. If we got above that level this morning, then we thought we had a pretty good chance that we had the shorts trapped. If those shorts, if we traded above the 2035.25 of the traders are trapped, the next upside reference becomes 20-40-25. That takes back all of the lower distribution from yesterday. So if you remember, yesterday afternoon, we thought people were short in the hole. The real change yesterday afternoon occurred right here when the market traded below 20-40.25. When it traded below that, that set up the break for yesterday afternoon. So if we get back to this reference, we then say, okay, all of that has been undone, so there is no change relative to yesterday. The next reference then becomes yesterday's point of control, or remember, a better way to think about that is the fairest price at which business was being conducted yesterday. So the market rallies back up to that fairest price level, pulls back one time and goes through. So there's, again, the validity of that reference. Then we tweeted this morning, well, you know, if there's a change relative to yesterday, it's going to be, you're going to see the fairest price become higher than yesterday. Okay, now, we'll go back and talk about today and what's going on, but what I want to do is I want to stop at this point, and I want to open it up to questions about what we saw, what we saw yesterday. How did we see the behavior, and how, using the profile, did we see that potentially setting up the trade that occurred early this morning? Questions, Julia? Questions based on what I have talked about so far. Then we will take the market forward to the next step.
Yes, sir. Thank you, Jim, very much. And we didn't tweet it. Jim chatted it in the training site chat commentary, just so people. It's okay. It's okay. That's cool. Just so there's no confusion. Some people asked. Is selling below the point of control but above the value area still selling short in the hole? Wouldn't selling in the hole be below the value area, not just the point of control? If you were selling short a break below the POC with an expected cover at the value area low, be an okay trade?
The selling, let me expand on that. That's actually a very good question. Is selling below a non-prominent point of control, in other words, a point of control that isn't terribly distinguishable. Let me see if I can break this out. So say selling below an E period when this is not a very distinguishable point of control. Selling below here isn't necessarily selling short in the whole. And the reason being because as time goes on, you know, this could widen out. We could trade here in F and G and H period, and we could widen the point of control, and we could actually see the point of control migrate lower, or the fairest price at which business is being done migrate lower. If the fairest price at which business is being done migrates lower, then that is usually an indication that I did have some more serious selling in the marketplace. And that time, sometimes in value, will catch up with price, and that may be a healthy progression. Now, changing the circumstances, and everything we talk about is contextual. And that's what makes traders get very frustrated when everything we talk about is contextual, because that's not what they really want to hear. They want to hear things being, in most cases, more immediate and more exacting. And it's not exacting. It's more of an art than it is a science. And so now, by the time we break in I period and we sell it below the point of control, the point of control is now 2, 4, 6, 8, 9 periods wide. As we break, and once it's this wide, the odds of being able to lower that point of control, or at least lower it very much. Throughout yesterday, initially the point of control was right up here around the 20, 47, 25 level. It did lower once yesterday down to the 20, 45, 50 level. It did lower once yesterday, but never enough to make a significant difference. It just showed us that there was some pressure. But once the point of control is this prominent, and you start to extend down here, the odds are much lower that you're going to be able to lower the point of control. So at this point in time, with this context, with the point of control this prominent or this wide, meaning from left to right, the odds are very good that you are selling short in the hole or selling short at very poor prices. Now, and what happened, I think, yesterday, there's just so much emotion in the market. There's so many people that trade first and think later, and that usually is a trap. If you were going with yesterday, it was one time framing lower, it's fine to go with yesterday's trade on the downside and continue to one time frame lower. The trade was when H period looked 2 ticks above G and didn't, let's spread that out one more time. When it looked 2 ticks above the G period high and then started to sell off, that is a great trade on a day time frame basis. Remember, the market's been one time framing lower. It tried to look higher and it got rejected. A lot of times this will be a single tick because there were larger traders waiting to sell it very aggressively at a very mechanical reference. Let me talk, while I've got this up, let me talk about some other information that led me to my chat comment that I thought we would probably take back the break. The C period high was a single tick above the B period high. D period went exactly to C period. What that tells me is that I have weaker traders selling exactly a single tick below the B period high, exactly at the C period high to sell D period. If longer term money was selling in the market, and again, we're back to this idea of understanding behavior based upon, you know, the people using the profile. If I had longer term money, they don't know where the B period high or the C period high or the D period high. When it happens this mechanically and this exacting, that is usually to me a sign that I've got short term money trading the market, not longer term, more serious money. E period comes up a couple ticks short. F period comes up 3 ticks short. H period looks 2 ticks above. So I see this all day long. So we've been selling for 1, 2, 3, 4, 5, 6, 7, 8. 8 periods they've been selling the market. And basically we're still right up here. So when I get that, so that very mechanical selling was another indication to me that I had day time frame or very short-term money selling the market. And rather than longer-term money, which was more sticky and less likely to see the retracement. So now when we get this break and go back to the original question, the point of control was very prominent at that level. And the more prominent it is, based upon the information that I just also talked about. So I had some history in the morning, looking to see how serious was the selling, and it doesn't look to me like it's long-term money. Then this gives me even more confidence that what I'm seeing is short-term money getting caught short in the hole. If you remember the chat comment, let me go back to that chat comment because it's extremely important. By that comment, I meant that I would not be surprised to see a rally later tomorrow or Friday. The tone continues heavy today. Okay, so I'm a realist. I'm watching the market, and I'm saying, what's going on today? What is going on today is that there are people out there that are just kind of blindly selling every tiny rally yesterday. That's why we saw so many of those 30-minute bars within a tick or so of each other. And finally, as the day gets later, the tone feels so heavy, they just throw in the towel, and everybody thinks the world is coming to an end. And I'm a realist. I'm not going to fight that tone. We wrote the tone continues heavy today. That's the tone that says I don't expect a rally today. And I said that. But I did expect the rally, today or tomorrow. One of the things we mentioned, we were on a phone call, and we were on a phone call with a client. It's been a client for some period of time, and the question I asked him, he's going to do an interview for us in a newsletter we're going to put out, and I asked him how he got to working with us and paying attention to what we do. He's also reported that he went from unprofitable to profitable from time to time and now consistently profitable. So it's been a good progression. He's a stunt pilot, so he knows what it takes to become an expert in something. He's watched that. But one of the comments that he made, which what kept bringing him back to us, he said he came to us through Shadow Trader. You heard us talked about by Peter Resnicek on Shadow Trader. He said when he first came and heard us talking, he really didn't make much sense to him. It was kind of hard to understand at first. But he said what he noticed was a lot of times there was a delay. Jim, he would say, well, Jim, I'd hear you say something, and I'd see the next day or later that afternoon, I'd see it come to pass, or maybe 2 days later. So he said I started to realize there was sometimes a delay in what was going on. Now, if you think about the chat comment yesterday, there was a delay. It happened today. And a lot of times what is taking place right now has a lot to do with setting up the odds for going forward. Too many times traders are so focused on the very short term and what is going on in price that they fail to recognize the opportunities that are setting up in front of them. But yesterday is a great example. It was still tradable yesterday. If you take a look at the message says tone for today continues heavy today. That says we're probably continuing to go lower today, but take a look coming out tomorrow. And that's exactly what happened. So there was a delay. But by using the profile, we could understand what was going on yesterday, but we could also have a better idea of what may be setting up going forward. And that's really what trading is about. And so many times, traders just they come in just blank. Okay, they start the day, they have no idea what they want to do the day. They just watch what happens. So we came in today. One of the final chat comments this morning was the 2035-25 was our key reference, and we said that a strong response would be to immediately trade above that. We also pointed out, to be fair, the overnight inventory was 100% long, and we know that the odds are that overnight inventory is corrected about 35% of the time. So in other words, if overnight inventory is long, about 65% of the time, there will be a counter auction to that overnight inventory. So we said the greatest odds early this morning were some chop. You know, because we said there was a conflict between, we thought the market was short from yesterday, and we thought there may be some longs from overnight. But we've also written extensively that if in fact a market is strong and the overnight inventory is short, and the market, if the overnight inventory is long, and the market disregards that overnight inventory and does not see a counter auction, that is a sign of a very strong auction. So the two scenarios we had this morning were, one, the strong response, that we go above the 2035 level and continue higher, or get some chop early this morning. Well, there's people, a lot of times people say, well, Jim, you talk about high confidence and low confidence openings. Well, what is the difference? Well, this is clearly a high confidence opening. It opens and doesn't look back. When you see that happen, get on the trade. Get on the trade. You've got a reference at 2035-25. Once you get above that reference, put your stop back down here and let this trade work for you. Now, if you understand what took place prior to today, you have a much better idea that your imagination says, golly, they were really short from yesterday, and your imagination says, we could have one heck of a day today. And that's what it was. But remember, we saw this setting up yesterday. And that's really what makes, that's really where you identify good trades. And then we had the references along the line. So back to the original question about yesterday, was selling below the point of control, was that really negative? And the answer is yes, that was selling short in the hole, and the reason we're selling short in the hole was because the point of control was so prominent at the time. I'm sorry I took so long on one question, but let's go forward with a few more, Julia.
Okay, thank you, Jim, very much. Just an overview question. Is the market profile, does it work just with futures, or can I use it in stocks?
I have made this comment before. I use the market profile for real estate. I use it for stocks. I trade some stocks from time to time. I use it for ETFs. The principles, any market, the principles are the same. Any market that is financial in nature revolves around the three principles earlier on. Price advertises opportunity, time regulates those opportunities, and volume measures the success or failure of the advertised opportunity. Now, you know, real estate takes a little longer time to advertise than does stocks, but the principles are exactly the same. In 1987, I lived in Northville, Illinois, which is, 25, 30 miles north of Chicago, and just before, there was a big crash in 1987, and just before that crash, I was going to sell a home up there, and I was keeping this a profile on real estate in that area. It's a very wealthy area. It's Northfield, and across the freeway is Wilmette, Winnetka, some high-priced real estate up in that area. And one of the things I noticed was right here. Houses were selling at higher prices, but the volume of the houses selling had dropped off considerably. I put my house on the market. I sold the house the first day. And as a matter of fact, it's actually sold to somebody that knew what was going on from the real estate agent, and the house was gone immediately. Shortly after that, we had the 1987 crash, and of course that area was devastated because there's so much dependent on markets. That house, by the time we went into closing, I would guesstimate that that house was down at least $100,000. And the funny story was the buyer was a bond trader from a firm that's no longer around, but called Shearson Hamel, or Shearson Hayden, I forget the exact name at the time. And I know that he knew he could walk away from his earnest money and be better off. Luckily for me, his wife was pregnant and he didn't dare walk away from that house. But again, the same principles. Prices were going up along with the market, but yet just as the volume was declining in '87 as the markets went higher, the volume was declining in home prices. So it worked very well for me in real estate, and I've done that throughout the years. So I think that the principles that's applicable to any market that is financial in nature. Another question.
Yes, sir. Thank you, Jim. We have a on H period, Jim, and this will speak to using longer time periods, but what time in period H did the price make that 2-tick, rise above G period? In other words, was it obvious in, say, a tick chart or tick bar chart or, another chart to execute the short?
I don't know. I never look at that stuff.
But if you look at down there, you obviously we're using, excuse me, Jim, but we're using 30-minute periods, Chris. Yes. So that kind of eliminates a lot of the noise, and I know we all have a propensity to go to shorter time periods. That's something we see traders jettison or move away from the longer they're with us, and I don't know if you'd see it because if you were on a tick chart, you may be seeing a bunch of ticks by the time it gets 2 ticks above G period's high. The tick chart may be showing all the noise, and you won't see it as clearly, I don't think.
The problem is, and I get confessions from people all the time that have been with us a long time, say, boy, it took me a long time. You kept telling me to get away from the 1-minute charts and the 5-minute charts and the 15-minute charts and the tick charts, and it was hard to break that habit. And they would tell me, I can't believe how my trading has changed once I finally broke that habit. The problem is so many times when you're looking at those short-term charts, your mind gets so short-term oriented that you lose the bigger perspective of what is going on. The other question that I usually add, and I have no idea who's asking the question, which is a real benefit, but what I say to people is, if what you're doing right now is working, then stay with it. If what you're doing right now and looking at those tick charts is not working and you're not consistently profitable, then it's time to rethink everything you're doing. My contention is that most people that look at these very tiny movements and tick charts and things like that get too short-term focused, and they lose track of the bigger picture of what's really going on in the market. But I can't answer the question for each individual person. It's just my observation, and I've traded for a number of years and worked with a number of people. But to me, it wasn't terribly relevant when it happened. It happened, and then the market started down. I think it was fairly quickly. What I'm always looking for when I look above that 30-minute bar, I would say, okay, was I rejected or was it accepted? And it was clear to me that it was rejected at that level. And I know from history, and Julia's heard, and those of you who have been with us heard us talk about this a lot. You get that 1 or 2 ticks on a day like yesterday, it's one time framing lower. You get that 1 or 2 ticks above a previous bar. A lot of times that happens because there's bigger money waiting, or at least more important, daytime frame money waiting to sell right at that level. All right, let me take a couple more questions, and then let me go and take a look and talk a little bit more about today.
Yes, I do think, just to add, that it can be very disorienting to, before you know it, you don't know if you're long or short. You're looking at these short-term charts. I think we've all, coming up through the ranks in our own evolution, coming to understand our trading, have seen where that can go south for us. So, but again, if it's working for you, great. Keep doing it. There's a lot of ways to trade, but if it's not, you might want to rethink it, as counterintuitive as it may feel. Yeah, we have a question right now, Jim, regarding the auction going on right now. Is there a potential short being created with week longs now trying to get at he's saying common low ticks in the days ahead. I'm not sure what he means by that, but right now, Jim, could we comment?
Okay, hold that question. Do you have any, I'll take that, do you have any other questions on what we've talked about so far before I switch over to what's going on right now?
Okay, do you see the short covering move today weakening this market and setting up an asymmetric downside move relative to the upside reward?
No. Okay, no, that's a question going forward. I'm talking about any questions on what I've talked about so far leading into tonight. Then I'll switch over to today's market. Just any of the stuff I talked about earlier. I'm guessing not.
How did the 45-degree line come into play yesterday afternoon? I was biased to the upside and leaned on that piece of information. When you, when Jim pointed it out on the, he's on the training site chat, I felt right. Although the knee-jerk sell-off ruined that. I was anticipating a short covering rally today, but didn't use that piece of information. Is the 45 line something to carry forward for today? 100%. Or is it null and void after the day it sold off yesterday?
No. Once it sold yesterday, it's very pertinent. Very pertinent. I can understand why you wanted to buy this early yesterday afternoon because of the 45-degree line. But remember, yesterday we were lower from the beginning. We were one time framing lower, and it's very hard to go in front of one time framing in there. And so, yeah, this could have been a trap. But once you got through there, it's very prone. That's the first price at which business was being conducted. Late in the day, I think the 45-degree line was very applicable. And a 45-degree line just means you can draw a 45-degree angle from and it's usually only a prominent point of control to the high. But also was even more important by this huge late break you got in M period that got the shorts trapped again.
The last, you know, the laggard sellers,
right here,
the last gasp, and the buyers who are squeezed out too. There's a lot of laggard activity there. Okay, and Jim, this kind of goes with, we're going to move on now, but you know, does this short covering weaken a market? Todd pointed out, he just wanted to mention, we now have 3 poor highs. From the excess. So, okay, I think we can move on, Jim.
Okay.
Yeah.
All right.
Okay.
So so what you saw today was a short covering rally. This is what they look like. One, all of the single prints are an indication when a market's moving that fast with all single prints. That's usually an indication of short covering or liquidation versus a combination of new money buying and short covering. When you look over, Julia, do me a favor, while I'm talking about this, I'd like to know what today's volume is relative to this time yesterday. And then I'll be talking, while you're looking at that, I'll be addressing today. Okay, now, the market, let's split out today. Okay, here's today's split up. So B, C, D, E, F, G, okay, we are continuing to one time frame higher today. Again, let's go back, short covering rally. If I had a good combination today of short covering and new money buying, more than likely my market is not going to become this truncated in this very narrow range between 2050.75 and the high up here at 2056.50. So again, that's important information for me to carry forward. That, in other words, basically what I'm seeing today is old business versus a more healthy combination of old business and new business. Now, a combination of new business and old business speaks better for upside continuation. And we're not getting good odds for that right now, but there's more to be said to that. The question was early on, short covering can actually weaken a market. When the market is very short, all those shorts are potential buying. How do you cover a short? You have to go long in order to cover a short. So once they go long and cover the shorts, that removes that potential buying power from the market. Additionally, then you get the people that pile on to the short covering, and you can have a market that goes from too short to too long. So you could be in here and having the shorts covered, which can weaken the market, and you could once again getting people going long, getting the market too long. So inventory could be now getting too long on this short-term basis. Another indication is once we looked above yesterday's high, and we've come back in several times, that's usually not a particularly good indication. That's not of strength. Now let me complicate this. You have a poor high today. I chatted earlier today that it was unlikely that the high was in for today. Market went back up, left another poor high, so I would tweet the same thing. Or not tweet, I would chat, make a chat comment. But if you look, one of the biggest things we talk about, an auction, the market is a series of continuous two-way auction processes. We auction from low to high and high to low. Those auctions take place in the long time frame, intermediate term time frame, short time frame, day time frame. So there's multiple auctions going on. If you take a look on the day time frame auctions, completion to any auction is a very important concept. Completion is evidenced by some kind of selling tail. The all-time high is made with no excess on the high. Two back-to-back poor highs, no excess again. So what this is an indication, these are the all-time highs, day following the all-time high. So what this is telling me that at the all-time highs, I got some liquidation. In other words, I got some liquidation from, money that was long, but I didn't get the more important, if I'm really going to go lower, I didn't get the more important combination of new money selling. If I had new money selling, in other words, think about longer term money saying the market hits all-time high and they say, wow, thank you for this opportunity, and they start selling aggressively. If that happened, I would have excess on the high or single prints. I wouldn't have two back-to-back poor highs. Now I come down and I've got another poor high. So I've got poor highs 1, 2, 3, 4, 3 out of the past 5 days, if I've read that right. So I got 3 highs, 3 poor highs, 3 of the last 5 days. The indication that the long-term auction has seen its high is very low. The odds are that we don't have this completion. So do I like today? No. Do I think the market may be getting short-term inventory too long? Yes. Do I think I have completion to today? No. Do I think I have completion to the long-term auction? No. Okay. Again, not particularly easy, right? There's conflicts all the time. Let me point out one more time here. So I do not like, as we go today, I do not like today, but I don't think it's completed. Julia, did you get today's volume versus yesterday's?
Yes, sir. It's 1.8 million versus, billion versus 1.6 yesterday.
Okay, so
as of 12:30, we're going to shift in 6 minutes.
Okay. So I have slightly higher volume today on a huge range, but I don't have any volume, any high volume that indicates to me, wow, I have a combination of new money, of short covering and new money coming in. That combination is not showing today. Showing I got short covering, but it's not showing that I'm getting new money coming into the market. So this is not a particularly healthy auction in here, but again, do I think it's completed? No. But earlier this morning, again, this has to do with short-term trading.
Jim,
go ahead.
A question from Sue. She's in the intensive training site, and she said it would be helpful when Jim makes these wise comments such as, I would be surprised if the auction is completed on the upside for today. I think you might have said that not long before we started the webinar. Could he elaborate as to why he thinks, so I can hone my own conclusions?
No, the answer is sometimes it's not as easy as that. Today was one of the things we talk about all the time. There was a poor high. There was no, and I think I said it's a poor high, and we know that poor highs are usually not a good sign that the market has been completed. But those answers are going to be a combination of maybe too far, too fast, a combination of the market widening out, combination of volume. So when I'm doing the chat comments throughout the day, I don't mean to be smart. So I'm not trying to write a book. I'm trying to keep it lively, and this morning would have been, I didn't think it was completed because of the fact that we did not have a good high, and I thought the odds would be very poor that I get 3 out of 5 poor highs. Can it happen? Of course it can happen. But I will try and do a better job of that going forward. So now we come back, and we got to do some other things in here. Do I like today? No. But I want to go back to the chat we were referring to earlier this morning. When we took out yesterday's high, as we spiked above that high, I put out a chat comment, and the chat comment said, I have stepped aside, and I would like to see the market come into short-term balance. In other words, as the market rallied, I made this objective, which was closing off the lower distribution when I printed above the 20, 40, 25 level. I made the POC, and then I looked above yesterday's high, which would have been, well, there was another reference in there. Yesterday, the pullback, the rally high yesterday morning at 2049.25. We also put a comment out on the chat this morning that was a reference because that was the yesterday morning's rally high. And remember, I showed you earlier, C period was within one tick of a B, D period was within one tick of C. Guess what's going to be above here? Stops. This was a reference yesterday. There's going to be stops above that level. Again, when we talk about using the profile in order to understand the behavior or anticipated behavior that people were competing against, the profile told me that right here, I was more than likely going to get stops. And take a look what happened when we printed there this morning. Look how the market spiked above that, and the prints took right there. Again, we talk about the chat comments. We're trying to identify these levels along the way. And again, this was, and incidentally, I didn't put a thing out yesterday to be stops here yesterday. Didn't get there yesterday, but it was one of those things, what I call is carrying information forward. And so it's one of those things I circle, I carry it forward. There's going to be stops. There was the B period high, C period high, D period high, and the early morning high. And again, you see what happened once we got there today. So again, we can't bring everything to you in a in a 1-hour webinar, but hopefully what we've been able to do is show you that how we use the profile organizes the market's continuous two-way auction process. By being able to organize the markets under the profile, we can better understand the behavior of the people that we are competing against. If I can understand the behavior of the people I'm competing against, I bring the odds in my favor, or said in trading parlance. That's how I get the edge. But again, maybe I made the comment so many times, traders want things to happen too soon. Remember the comment I put out yesterday. The tone yesterday was to the downside. That was the behavior yesterday. But I said I expected tomorrow afternoon or Friday to see that taken back. Well, it happened earlier this morning. So there's a lot of complexity going on. But it's that paying attention to the market, it's continually understanding how does a market move from one direction to another. How did that happen? Was it solid? Was there weakness? Was there structural weakness in it? Was it new money? Was it old money? Who was more than likely doing that? Were they trading it? Were they selling prices, below value and below the fairest price? There's a lot of information there, but understand this is what it takes to be profitable in the market and compete against the world. Remember, only a small percentage of people make money trading. Most people will not give you the information that Julia and I have. Some because they don't have it, others because they might have it but they won't share it. But it's not a formula, folks. It's not a formula. It takes a deep understanding of the market. And what we've been trying to do, both through the intensives and through these chat comments, is to be as close to you on a mentoring basis as we can be. Most people, if they went to get this mentoring one-on-one, it's $30,000 to $50,000 a month. I mean, I know that sounds ridiculous, but I've actually gotten those fees on when I've done some individual mentoring, on a client or institutional client for a month. And we bring this to you at an extremely reasonable price, and we're very dedicated to what we do, and we do care. But we also are trading all the time, full time, as we make these comments. So again, that's the chat comment. The chat is part of the intensive. And the idea for the intensive, I know a lot of people have heard this, but if you haven't, if you're new, we used to do, we go to hotels in the standard way. We do a seminar 3 to 5 days, and we got lucky on a couple of them. The last one we said the market would probably open weak and close strong, and we got a 400-point rally in the last 40 minutes of the day. Can't get much luckier than that. But as we walk away from it, Julie and I were talking, I was very frustrated because people really weren't able to take the information and do much with it for multiple reasons. One, even if we impart a tremendous amount of information in a 3-day period, you can't internalize that much information. And secondly, you're not going to see that many different trading days over that period. So as you see, the markets, every intensive we have done, the markets have been totally different. So it's like a new experience. And this is how you become expert at something, getting constant exposure to different kinds of markets. Because one of the things you have to do to be a successful trader is being able to operate in any kind of market. Some people out there, and they'll tell you, well, find out what your strength is, and find out and trade to your strength. Well, I really don't buy that. I mean, it sounds good. These things sound intuitively good. However, the market doesn't adapt to you. You have to be able to adapt to the market. You have to be able to recognize when a market has changed, and then you have to be able to trade according to that particular market. Now, let me finish up by going back and reviewing today. We are in a very tight balance between 20, 50, 75, which is, a C and D period low, so there's going to be stops below this, and a very poor high up at the 2056 level. We have a point of control in this upper portions here. So again, this is the P formation. So one of the things, the P formation, like the letter P, you have a very long stem. There's your very long stem. And the top of it looks like the loop for the letter P. It's usually an indication that you're seeing old business, in this case short covering, versus a more potent combination of short covering and new money buying. If we had a more potent combination, we would have easily traded above yesterday's high and extended upwards. So again, is this very healthy today? No, it's not. Does it look completed? No, it doesn't. There is a conflict. And of course, you're coming into the end of the year, and who knows what they do. But for right now, I don't like this market, but it's certainly, the shorts have been punished again today. I do not see completion to the market. My odds say that before year end we go higher. Okay.
Yeah, a couple more questions, Jim.
Oh, sure. Okay.
Was the overnight sentiment for this morning's pit session an indicator of a potential up move, or was it just the low volume on yesterday's move down? Were you incorporating the overnight at all in today's early session auction, in your analysis? If you could show that, please.
Just the opposite. Remember what I said early on. If you take the overnight sentiment, was higher. So overnight inventory was long, and we know 65% of the time there's a counter auction to overnight inventory. So no, the overnight inventory was actually a negative. But the positive, as we've written, is if the market disregards overnight inventory that is long and trades higher, that's a sign that the market is strong, at least for that period of time. It's a very positive strong. It only happens 35% of the time. When it happens, that's a good indication it's strong. The biggest thing, the biggest indication, and the reason I chatted what I chatted yesterday was the very prominent point of control, the very mechanical way the market kept selling off a tick or two relative to a previous day. That's not strong money selling. That's weak money, emotional, knee-jerk type of selling. And then, of course, the volume yesterday did not confirm that I had really good selling on the downside. Okay?
Yes, and then, everyone's seen the morning report, or I didn't mention, but you saw it on the screen capture before we started, that the reports and the slides are at this webinar post. And in the morning report, you had drawn the line in the sand with the rally high from M period yesterday. If you pull up your profiles there at the 2035 quarter. So once we started having an opening drive early, and we went above that level, that indicated something had changed from the downward auction from yesterday. I mean,
absolutely.
It happened pretty quickly, but you could see they were trapped. The price action.
But it had to do so much with understanding yesterday, understanding the reports we put out, and understanding how we got to where we got. But I think that, to me, the last key piece of information was this rally up in the late break in M period. This is where the real trap took place. You got some rally that relieved some of the short covering, and then you got the non-thinkers that just couldn't wait to, afraid they're going to miss an opportunity, that sold the daylights out of this market. And that was also the overnight low. They were trapped big time. Okay.
Yeah, that really set the short trap at the end of that session. They really just, that 100%. Was like that, yeah. And Jim, Rob's making a comment here. This is a great comment. You have the opposite setup today on the upside with the lows C, D, E, and F being relatively close together, and now G and H. You know how you were talking about them selling off of that very mechanical, the highs of every 30-minute period. Rob's making the point that today we've got the same type of buying on the lows, very mechanical, tick off the previous 30-minute bar. Do you have a comment about that?
Is that Detroit, Rob?
Yes.
Hi, Rob. I remember the first webinar Rob ever came to.
A seminar.
Seminar that we had in Chicago, and very little knowledge on this. I think he won that trip somehow. But anyhow, he's been with us ever since. But it's a great observation. The differences, the contextual differences right now is that you've got 3 out of 5 days of poor highs. Very, very difficult market in here. But the selling, the rally today looks like short covering. The buying is very mechanical. D period at exactly at the C period low. You're absolutely right. E rallies, one tick above. F rallies 1 tick above E. G goes right down here. It's really not a very pretty situation. I could see that this thing could trade down here and give you kind of a distribution through here this afternoon. But it's not a high confidence day. Could easily break. It could easily get the same kind of rally we got yesterday. So I'm neutral. I'm short-term neutral at this time. Do I think the market's going higher before year end? Yes, I do. Do I like today? No, I don't. Do I think confidence remains low? Yes, I do. So I'm just going to continue to play it by ear. Okay.
Is there any do you find anything important about we've stopped daily one-time framing lower today? by taking out Wednesday's high?
Not really. I mean, I understand we did, but I'm not. My focus is really on the fact that I've got these poor three out of five poor highs. So I'm getting more emotional liquidation and selling, but I'm not getting any serious selling coming into the end of the year. But again, like I said, today is when I look at the P formation, we got the market went very strong early on, mostly short covering, not a sign of new money buying. So it's not a particularly healthy environment in here. But like I say, I'm overall neutral. Do I like the rally? No. Do I think the highs are in? No. So what have I done? I'm just trading on day time frame basis, except if I get an opportunity like yesterday afternoon. I did, at the very last minute, I did go home long calls yesterday, simply because the risk reward seemed to be attractive. Early on, I thought I had no intention to do anything yesterday. I just said I got saved from being whipsawed. Had I been long early, I'd have gotten whipsawed when this broke down. When this broke down here late, I just couldn't resist it. It just looked like a pretty good risk-reward opportunity to buy some out of the money calls, just because I thought the shorts were there. But it certainly wasn't because I believe that this market is very strong. I don't have any real faith in this market. So now, H period has stopped one time framing. We'll see what happens. Now we took it up by 3. I would think with the chances are we get some rotation in through here. A little short covering.
A little liquidation.
I'm sorry, a little long liquidation.
Yeah.
I wouldn't be terribly surprised to see us rotate back up. But again, it's always dangerous. When you're back into a previous day's range, it's always a dangerous situation. But I'm going to leave it with, right now, I have no strong convictions in here. I will tell you what I did to base it. First of all, when the market looked above,
Want to mark that? Just click it.
When the market looked above yesterday's high this morning, I exited and I put out a chat comment that I stepped aside. When the market broke back down in here, I had a poor high up here. The market broke. I went out and I bought some more calls. As soon as the market looked back up here at the 55.50 level, I sold 50% futures against the calls. It's really a volatility play to give me volatility either up or down from that point in time, because I thought I was a volatility play, not a directional play. But I just thought that today looked kind of sad, so I thought I'd either get a shot to really ramp to the upside or do something serious on the downside. But it's really a nothing position unless I really get a move up or down between now and the close tomorrow. Anyhow, one more time, thank you. But let me show our final slide here. And
you got to put it on full screen though, because you can't.
I know that. It just takes me a little while to get all this.
So savvy technically.
The intensive coming up, January 20th to the 24th, 5 weeks. The intensive includes between 8 and 9 hours per week of online sessions that I do live narration and instruction. So if you take over a 5-week period, you're talking 40 to 45 hours of, live presentation. Includes a real-time intraday chat at the training site. We provide commentary when we're not in session. I chat all day long unless I'm, at a doctor's appointment or something. And I stress that because I've just had a knee replacement, so I've had to have some PT, and I have had a couple of doctor's appointments. You get 2 daily reports every morning, and we do the recap and preparation report every evening. The important thing is that you don't find, we're talking about real markets. We're not going back and talking about using past examples and pointing things out. We're talking about real markets and things that are going on right now. It's as hands-on as you can normally get in a market. And like I say, we attempt to hold nothing back. Julia is a 50-50 partner with me. She does a tremendous amount of support when emails and people have questions. Sometimes she filters the questions to me with her experience now. Most of them she answers on her own. But it's a 50-50 team. We are here to give you as much support and education as we possibly can in the 5 weeks. And you have the ability to sign up for the intensive now. And also, for a little add-on, you can get included the chat comments for the remainder of December. There is no charge for starting January 1st. There is no charge for the chat comments. They're part of, once you sign up for the intensive, you get those. But I'll tell you that the fastest you can get on to get the daily chat comments
and the reports,
and
really,
the reports
are
the
huge.
better off you're going to be to build a solid base and the continuity to what we talked about today. Once again, thank you all very much, and we look forward to our next webinar with you. Bye now.
Okay, and Jim, thank you very much, sir. Can I ask one more question before we all part ways here?
Of course.
It's important. Well, I want to make sure he gets it. Do you consider inside and outside bars in the market profile? If we could look at your window trader again, Jim, we do. And when you sign up, we have a signature trades worksheet. It's about 22 pages, and we'll be adding to that as we continue on. But an inside bar is certainly a trade that a 30-minute inside bar, particularly if it's not wide and it's a pretty narrow range, it can be an excellent opportunity to sell a breakout of it.
It doesn't have to be a single bar. It could be like, for example, the EFG bar,
right,
a daytime frame trade. You know,
yeah.
It's a legitimate trade when you break down and you come out of balance. Excess and balance, the two most important concepts you'll ever deal with in here. You come out of balance, whether it be an inside bar or multiple bars, those are legitimate short-term trades. You take the short here, your stop's up here, your first destination trade is down to this level. Then if you've got a good trade, you want to see another breakout below the BCD, or the CD now H low. This low has deteriorated even more because we've been down there again. All right, once again, thank you all very much. Bye now.
All right, thank you, Jim, very much. We appreciate it, and thank you, everyone, for taking time out and spending the hour and 20 with us. And good trading, everyone. Keep in touch. We'll see you next week, December 18th. Check our website. That's our next webinar. Okay? Be well. God be with you. Bye-bye.